Welcome to Group Insurance Daily Pulse, your rapid-fire download of the most critical developments impacting the group benefits landscape. I'm Aria, the actuary, ready to dissect the underlying risks and P&L implications.
And I'm Dorian, the distribution expert, here to highlight the market opportunities, ROI potential, and strategic shifts defining our industry. We've got a packed 15 minutes, so let's jump straight in. First up, some significant product innovation from Guardian. On June 15th, they rolled out Critical Illness Essentials and Combined Life and Critical Illness Essentials. The headline here, Aria, is affordability and accessibility, targeting budget-conscious employers. They've also reduced the critical illness survival period from 14 days to 10 days for new policyholders, a direct enhancement of policyholder benefits, and clarified 7 key definitions.
Affordability is a word that always raises my actuarial antenna, Dorian. While expanding market reach is certainly a distribution goal, the immediate question for me is the impact on premium adequacy and claims experience. Reducing the survival period from 14 to 10 days, while beneficial for the policyholder, fundamentally alters the morbidity assumption. This isn't a minor tweak. It directly increases the probability of payout for certain events, potentially accelerating claims velocity and frequency. Has Guardian sufficiently repriced this reduced exposure period into their essentials offerings, or is there a strategic margin compression at play to gain market share? We need to ensure the pricing models account for this increased claims liability, especially for conditions with high short-term mortality. Furthermore, clearer definitions are always welcome from a claims processing standpoint, reducing ambiguity and potential litigation risk. However, we must ensure these clarifications don't inadvertently broaden the scope of covered conditions beyond initial pricing assumptions, leading to adverse selection or higher than projected payouts. From a solvency perspective, increased claims velocity necessitates robust liquidity management and adequate reserving.
The Department of Insurance will be scrutinizing these essentials products, ensuring they offer genuine value commensurate with the premium, and that the carrier maintains appropriate capital levels given the modified risk profile. The balance between market competitiveness and actuarial soundness is razor thin here. All valid points, Aria, but from a market perspective, the value proposition to the employer is enhanced. That 10-day survival period is a tangible benefit that improves the perceived value and utility of the product, which drives enrollment and utilization. The clear definitions streamline the claims process, reducing friction for both the employee and the employer's HR team, which contributes to higher employee satisfaction and retention. These essentials products are designed to be a gateway, potentially leading to broader adoption of critical illness coverage across diverse employer segments previously priced out.
Strategic growth must be underpinned by robust financial modeling, Dorian. The actuarial impact of accelerated payouts needs to be continuously monitored against experience. If the essentials products capture a significantly different risk profile than their standard offerings, the morbidity tables will need swift recalibration. We're talking about potential shifts in claim incidence rates, average claim size, and payout patterns. This isn't merely a pricing exercise. It's about managing the capital required to back these liabilities. Carriers must demonstrate to regulators that these new offerings are sustainable, not just competitive. The long-term solvency implications of a book of business with a higher claim velocity and potentially thinner margins are a significant concern.
Fascinating push and pull there. Moving from product innovation to policy influence, let's talk about the Hartford. On June 14th, the Hartford Insurance Group filed a new lobbying registration with Venn Strategies LLC, deploying a 4-person team with extensive congressional experience. This isn't just a casual engagement, Aria. This is a proactive, strategic investment in shaping the federal policy landscape. Their lobbying efforts will span healthcare, insurance regulation, taxation, and even the automotive industry. For carriers, this signals a commitment to influencing legislation that directly impacts their various business segments, especially their significant group benefits and employee benefits operations amidst ongoing policy debates. For brokers, this means potential shifts in compliance requirements, product availability, and market dynamics that could reshape how they advise clients. Favorable operating environment for whom, Dorian, and at what cost to the broader market or regulatory stability? While proactive engagement is understandable, the scope, healthcare, insurance regulation, taxation, is incredibly broad and carries significant potential for systemic impact. My immediate concern is the potential for regulatory arbitrage or the creation of market distortions if specific legislative changes benefit one carrier disproportionately. From a regulatory perspective, we need to ensure transparency and fairness.
What specific aspects of insurance regulation are they targeting? Are they advocating for changes to ERISA preemption, state DOI authority, or federal oversight of group health plans? Any shift here could have profound implications for compliance frameworks, solvency capital requirements, and even the enforceability of contracts across state lines. Taxation, too, is critical. Changes to deductibility of premiums or the tax treatment of benefits could directly impact employer willingness to offer robust plans, thereby affecting the entire group benefits market P&L. Lobbying costs themselves are an expense that must be justified by anticipated returns, but the potential for unintended consequences, such as increased regulatory scrutiny on the industry as a whole, or shifts in actuarial reserve requirements based on new mandates, cannot be ignored. The risk here is not just financial, but systemic, potentially introducing new layers of compliance complexity for all market participants.
The intent, Aria, is typically to create a more predictable and stable regulatory environment, which benefits all participants by reducing uncertainty. For employers, clarity in federal policy means they can plan their long-term benefit strategy with more confidence. For brokers, a consistent regulatory framework simplifies compliance advice. The Hartford, as a major player in group benefits, has a vested interest in ensuring that legislative outcomes are practical and sustainable for the employer-sponsored system. This isn't about gaining an unfair advantage. It's about having a voice at the table to prevent overly burdensome or ill-conceived regulations that could stifle innovation or make group benefits unaffordable.
Stability is one thing, Dorian, but the devil is in the details of the specific policy changes they advocate. For example, if they push for changes in how group health plans are regulated under federal versus state authority, that could create a patchwork of compliance requirements or even preemption conflicts that destabilize the market for other carriers operating nationally. From an actuarial standpoint, any shifts in tax policy affecting premium deductibility or benefit taxation could fundamentally alter the demand elasticity for group products, impacting future premium volumes and consequently carrier P&L and growth projections. The risk isn't just in the direct cost of lobbying, but in the potential for increased volatility in the regulatory and economic landscape, which directly affects capital allocation and long-term business planning across the entire group insurance sector. We must monitor their specific legislative agenda closely to anticipate potential impacts on solvency, reserving, and overall market dynamics.
From policy to people, let's look at a key hire in the brokerage space. Alliant Insurance Services announced a significant strategic hire on June 15th, bringing Kristin Searcy on board as Senior Vice President within their employee benefits group. Searcy brings over 2 decades of experience developing solutions for executives and organizations, and this appointment is squarely aimed at expanding Alliant's strategic advisory capabilities, particularly in the Southeast region and beyond. For carriers, this signals an increased demand for sophisticated advisory services, meaning they'll need to ensure their products, data analytics, and support align with the enhanced capabilities of leading brokerage firms. For brokers, it underscores the intense competition for top talent in the employee benefits consulting space, highlighting the value of specialized expertise in delivering high-value solutions.
And for employers, it means even more robust and strategic guidance in designing and managing their benefits programs, potentially leading to more innovative and effective solutions for talent attraction and retention. This is about elevating the level of strategic partnership in benefits consulting. While it's clear Alliant is investing in enhanced advisory capabilities, my concern immediately shifts to the implications for carrier P&L and underwriting. A more sophisticated broker, armed with deeper expertise, often translates to increased pressure on carriers for bespoke solutions, tighter underwriting concessions, and potentially more aggressive negotiation on behalf of their clients. This could lead to a compression of carrier margins, especially if the expectation is for highly customized plans that deviate significantly from standard offerings. From an actuarial perspective, complex, tailored plans can introduce challenges in pooling risk effectively and maintaining premium adequacy across a diverse book of business. We need to ensure that the increased demand for innovation doesn't outpace the ability to accurately price and manage the associated risks. Furthermore, if these strategic advisors are pushing for more innovative funding mechanisms or alternative risk transfer solutions, carriers need to have the appropriate capital reserves and risk management frameworks in place to support them. There's a fine line between innovation driven by market demand and taking on undue risk. The strengthening of broker expertise will invariably lead to a more discerning client base, demanding greater transparency and data-driven insights from carriers, which requires significant investment in analytics and reporting infrastructure.
Aria, this isn't about undue risk. It's about optimizing value and driving better outcomes for employers and their employees. Highly experienced consultants like Searcy are instrumental in helping employers navigate the complexities of benefits design, ensuring plans are not only cost-effective, but also align with organizational goals and employee needs. This drives demand for carriers who can be true partners, offering flexible products and robust data insights that justify their value proposition beyond just price. It pushes carriers to innovate, to develop more granular data analytics tools, and offer solutions that truly differentiate in the market. This competitive pressure ultimately benefits the end user, the employer, and their employees by fostering a more dynamic and responsive benefits ecosystem. The ROI for employers here is tangible: optimized benefit spend, improved employee engagement, and a competitive edge in talent acquisition.
Carriers who embrace this shift and provide the necessary support and flexibility will be the ones who gain market share. The actuarial challenge remains, Dorian. If enhanced advisory capabilities lead to more precise risk segmentation by brokers, it could create an environment where carriers are left with a less favorable risk mix in their standard pools, or are forced to offer highly customized, potentially less profitable solutions to secure business. This phenomenon, known as cherry-picking or adverse selection at the group level, requires carriers to continuously refine their underwriting guidelines and pricing models. We must ensure that the premium rates accurately reflect the specific risk characteristics of each group, not just the overall market averages. The capital requirements for bespoke, complex solutions can also be higher, impacting solvency ratios. Carriers need to invest in advanced predictive analytics to stay ahead of these trends and maintain profitability in a market driven by increasingly sophisticated client demands.
From talent acquisition to technological advancement, let's pivot to Origami Risk's latest innovation. On June 15th, Origami Risk, a leading SaaS technology firm, launched new insurance program management capabilities within its Risk Management Information System, or RMIS. The standout feature here, Aria, is AI-powered policy data ingestion. This is a game changer. It automatically extracts structured data from complex policy documents, drastically reducing manual administrative effort and significantly improving data quality. This functionality centralizes renewal workflows, tracks quotes and comparisons, and provides program-level analytics. For employers, this means a massive reduction in administrative burden, enhanced accuracy in managing their entire insurance portfolio, including group benefits, and better decision-making through data-driven insights.
AI-powered always sounds promising, Dorian, but it immediately triggers a cascade of questions regarding data integrity, security, and regulatory compliance. While the promise of reduced administrative effort and improved data quality is attractive, what is the validated error rate for this AI-powered ingestion? Imperfect data extraction, even at a low percentage, could lead to significant downstream issues in claims processing, policy administration, and, crucially, actuarial reserving. Misinterpreted policy terms or incorrect data points could result in overpayments, underpayments, or even regulatory noncompliance, particularly for group benefits governed by ERISA and state DOI regulations. Data security and privacy are paramount, especially with sensitive group health and life policy information. How is this data protected within the RMIS, and what are the audit trails? From a carrier perspective, while this improves employer-broker efficiency, it also means carriers must be prepared to integrate with, or at least accept data from, these advanced RMIS platforms. This requires robust API capabilities and data governance standards. The risk isn't just in the AI's accuracy, but in the potential for a disconnect between the data ingested by the RMIS and the carrier's system of record, creating reconciliation challenges. Solvency implications could arise if faster, more accurate data leads to accelerated claims processing that outpaces premium collection or the timely adjustment of reserves based on real-time experience.
The focus, Aria, is on transforming manual, error-prone processes into a data-driven system. The accuracy and security protocols for leading RMIS platforms like Origami Risk are incredibly stringent, often exceeding basic regulatory requirements. The AI is designed to learn and improve, and the reduction in human error from manual entry alone is a massive gain. For carriers, the benefit is in receiving cleaner, more consistent data from their employer clients and brokers, which can in turn improve their own operational efficiency and actuarial modeling. This integration of technology across the value chain ultimately strengthens the entire ecosystem. For employers, the ROI is clear: less time spent on administrative tasks, fewer errors, and actionable insights to optimize their benefit spend.
Unlocking value must not compromise the foundational principles of risk management and regulatory adherence. The learn and improve aspect of AI implies a continuous evolution, which means the initial validation of its accuracy and security needs ongoing monitoring. From a P&L perspective, if carriers are to truly leverage this cleaner data, they must invest in their own AI ML capabilities to process and interpret it, or risk becoming data-rich but insight-poor. The potential for faster claims processing, while beneficial for policyholders, means carriers need to have their own internal systems and capital structures ready to handle increased claims velocity without impacting solvency. We need clear frameworks for data ownership, liability for errors, and auditability to ensure this technological advancement provides a net benefit without introducing unforeseen actuarial or compliance liabilities. The regulatory environment is still catching up to AI in insurance. Until then, caution and rigorous validation are paramount.
And finally, a sobering look at health benefit costs. The latest Mercer report, widely cited on June 15th, projects a substantial 6.7% year-over-year increase in U.S. health benefit costs for 2026, pushing the average cost per employee to at least $18,500. This is a critical data point, Aria, driving significant employer responses. Almost half, 48%, of large U.S. employers are planning changes for 2027 that will likely result in higher out-of-pocket costs for employees, such as increased deductibles or co-payments. And notably, in 2026, 6% of large employers dropped coverage for weight loss GLP-1 medications, with another 27% implementing tighter utilization controls. For carriers, this is a clear signal to adapt product offerings and pricing strategies to meet the demand for cost management solutions.
Massive market opportunity, Dorian, or a massive actuarial challenge? A 6.7% increase, pushing average costs to $18,500, is a significant jump that directly impacts premium adequacy for 2027 renewals. My immediate concern is the widespread trend of cost shifting to employees. While it may alleviate immediate employer P&L pressure, it carries substantial actuarial risks. Increased deductibles and co-payments can lead to delayed or foregone care, which could result in more severe and thus more expensive conditions down the line. This isn't just a moral hazard, it's a morbidity risk. Furthermore, cost shifting can exacerbate adverse selection, where healthier employees opt for less comprehensive plans or even forego coverage, leaving a higher risk pool for the carrier. The 6% of employers dropping GLP-1 coverage and 27% implementing tighter controls is a double-edged sword. While it may reduce immediate pharmacy spend, the long-term health implications of restricted access to effective chronic disease management, particularly for obesity and related comorbidities, could manifest as higher medical claims in other areas down the road. Carriers must carefully price for this volatility and the uncertain long-term morbidity trends.
The reality, Aria, is that employers are facing unsustainable cost trajectories. The actions they're taking, cost shifting and GLP-1 controls, are direct responses to that financial pressure. Our role, as an industry, is to innovate within these constraints. For carriers, this means developing more sophisticated risk-sharing arrangements, promoting value-based care models, and offering flexible plan designs that can be tailored to an employer's specific risk tolerance and budget.
Optimizing value must include a rigorous actuarial assessment of the long-term financial implications, Dorian. The immediate savings from GLP-1 restriction, for example, could be dwarfed by future costs associated with uncontrolled diabetes, cardiovascular disease, or other obesity-related conditions. Our pricing models need to incorporate these potential shifts in morbidity and utilization. Furthermore, the increasing complexity of plan designs, with various tiers of cost sharing and carve-outs, makes accurate claims forecasting and reserving incredibly challenging. We need more granular data and predictive analytics to understand how these changes impact claim frequency, severity, and ultimately carrier P&L and solvency capital. The regulatory landscape around GLP-1 coverage is also evolving rapidly. Carriers must be agile in adapting their policies to avoid compliance pitfalls while managing the underlying actuarial risk. The industry is navigating a tightrope between affordability and adequate care, and the actuarial profession is at the forefront of quantifying that delicate balance. And that's all the time we have for today's Group Insurance Daily Pulse, a dense but critical dive into the latest developments.
Always a pleasure, Aria.
Until next time, keep your finger on the pulse.